forecasts. Let's get more on this result now. Chris Weston from IG in Melbourne joins us. Chris, good morning to you. Earnings easily beating expectations, $3.5 billion. That dividend coming in line with expectations. But did that 10-cent special dividend come as a bit of a surprise?
Not a huge amount, Liz, unfortunately. Look, I think basically if you looked at the situation with Westpac, they have had improvement in return on equity. You know, they've got about just over $1 billion in surplus franking credits, which, you know, obviously they could have used for any kind of capital management initiative. I've seen a bit of research of late from a number of different banks, but I think most of them had been expecting the special dividend to be paid in the second half result, the full year numbers there. So I think the fact that they've brought this home to the first half would probably surprise people in terms of the timing. But I think given that the improving return on equity, the surplus franking credits this bank had got or has, the special dividend was never really out of the question in the first place. Like I think what we're seeing here from the dividend to 86 cents was a decent payout ratio. Given that their underlying earnings beat expectations, it's probably somewhere around 75%, 75 up to 80%, which is obviously higher than what we're seeing from ANZ, but that was always going to be the case. So people will be looking at this dividend, you know, certainly in a very positive light. It's all about yield globally at the moment. You're seeing that in the sovereign debt markets with people looking to buy Spanish, Italian debt. You're seeing that in the US, of course. There's been a huge number of companies here doing capital management initiatives. Apple the other day coming out of its bond issuance, everyone wanted a piece of that. And in Australia, I mean, the trade has been to buy yield. Telstra doing very nicely, the bank's doing very nicely, and this will just really keep that momentum going in the short term. Obviously, ANZ got a lovely lift the other day because it came out with a higher payout ratio on the year, and obviously trying to narrow that spread and the divergence between the first and second half. So I think these earnings numbers we've seen today from Westpac are good. Certainly the cash earnings have easily beaten expectations, and this special dividend will reinforce that as well. Everything else, like net interest margins, were very much in line. If you look at costs to income ratios, they're pretty much in line with what the market's looking for. Return on equity was perhaps just a touch higher. So yeah, I think on the margin, this is a good result and should definitely please investors today.
OK, let's talk about some of the movements overnight in offshore trade. The ECB meeting, of course, delivering the market what it wanted with that rate cut of 0.25% to 0.5%. Eurozone data, it also has seen the euro soften in overnight trade as well. What now, though, in terms of event risk going forward?
Well, I think we're obviously going to keep our eyes very firmly on the inflation numbers, because obviously the ECB do have a single mandate, which is price stability. They don't look at employment as closely as, say, the Fed do with their dual mandate. So it's really about price stability, and the recent CPI print we saw in Europe at 1.2% is the key there, because it's significantly below their targets. Now, Mario Draghi did reiterate his view last night that there should be growth in the second half, but there are downside risks. So of course that's going to be the metric, and they are technically going to stand ready to act, and that's another key message that he has. So the first situation will be probably another cut to the refinancing rate, but he has an open mind, in brackets, on imposing negative deposit rates. Now, Mario Draghi, even more so than Ben Bernanke, is a master of communication. This guy is more respected in terms of communication exercises than any other central banker in the world, and he's done it again. I mean, he has come out and said that, put it quite vocally, that if the situation deteriorates, then we will impose negative deposit rates. Something that in the price statement he talked about the serious unintended consequences around those negative deposit rates. He removed that this time, and if we do see a continued fallout in inflation and some of the economic metrics that we're going to see around the region, then potentially it will become a serious reality that they do impose negative deposit rates, which is a massive situation for currency traders, because if he basically charges banks to park money with the ECB, where are the banks going to go? They're going to either lend into the real economy, which is a low possibility, or they're going to look offshore. They're going to look into the UK, they're going to look into the US, other parts of Asia, perhaps even Australia, of parking their money somewhere else. Of course, those outflows will cause a massive negative move in the euro, hence why when Mario Draghi actually started speaking last night and mentioned that the negative deposit rates, we did see the euro absolutely collapse. The cut didn't cause anything. In fact, actually, we saw the euro rally after the rate cut. because it was pretty much all priced in. It was when he mentioned that he stands ready to act on the negative deposit rates. The euro traded down to around the sort of low 130 regions, dropped about 150, 180 pips or so. So the sharp reality now is that, you know, like the Fed have got with this Bernanke put on steroids, as I'm calling it, where, you know, worse data, worse inflation forecast, worse employment will mean that they can potentially ramp up their asset purchase program. The no sharp reality in Europe is the worse the inflation data gets, the higher chance there will be of negative deposit rates, will therefore be a significant euro negative, and the euro will be you know, the #1 funding currency of the carry trade again.
Chris, what's the likelihood of some of that money coming to Australia, either to fixed income or equity markets?
Well, I mean, the yield on offer in Australia is now becoming quite low. I mean, we've got a 3% yield on the 10-year, which is, or just above that, 3.02 I think it closed at yesterday, which, you know, since November it's actually been above the cash rate. So, you know, you can still pick up a pretty decent yield here. Of course, you can still pick up a decent yield comparatively in the deposit rates as well. That will continue to come down over time. Yeah, some of that money may come down over here. I think in the first quarter we did see sizable inflows, something like $16 billion into Australian bank accounts. Unfortunately, I didn't have the data to separate whether that was European or Chinese or whatever the destination is. But some of it could come over here for sure. But I think in Europe they have a tendency to look into the UK you know, ultimately what this is, Liz, is it's very, very low risk money. This is money that's been parked with the ECB, not getting a return, zero rates. So they're not going to be suddenly going, oh, we need to suddenly find 3% rates. There's a huge amount here. They just want the most secure funds. So I think probably the UK would be the most likely destination, as well as the US.
Okay. All right, let's talk opening calls for the local market here. We saw another stellar session on Wall Street overnight with the S&P 500 closing at an all-time high just after the closing bell, and pretty good night for commodities as well. Do you see that flowing through to a better session today? We've been lower for the past 2 previous sessions.
Yeah, I think on an index level, I mean, prior to the Westpac result, we had the market open very much in line with the SPI, up about 0.6%. It was going to be a good day, good finish to the week. There's a pretty good chance we're going to see Westpac doing quite nicely. I think Westpac was up 30% live prior to the open of today, and a large amount of that gain had been premised on the previous CBA result, where we were seeing that big improvement in net interest margins, and obviously people looking and see if that was going to be reiterated in Westpac as well. So I think Westpac's going to be key. Macquarie, as I mentioned prior to me speaking, is obviously in focus today. And obviously we're going to be looking for something like $820 million worth of underlying profit for that company, and of course the dividend's going to be largely in focus. I think you're looking at the material space. Iron ore down about 3.5% from where it closed last week. That's going to be very much interesting. So may put a bit of pressure on Fortescue. BHP's ADR is pointing up about 0.8%, and there was a slight move up in copper last night, with a big move in terms of the commodity complex clearly in the WTI space. I mean, it was up about 3.5% from yesterday's close, so that needs to be priced into oil stocks after yesterday's big falls as well. So oil and gas, one of the best performing sectors on the S&P, it's likely to do quite well here as well.
All right, Chris Weston from IG, thanks so much for the update. Appreciate it.
Thanks, Liz.